you guys going to be using Pearson as a system for the exam, it will be a combination. I mean, it will mostly be a combination of multiple choices and like little problems, which I mean at this point, I mean you guys know Pearson, and like the problems are somewhat guided with drop down menus. So I mean obviously like I can't give you the extent of like how many questions we have in the exam. I typically don't share that just because it may create unnecessary enthusiasm or unnecessary panic, either one or the other. And the exam has been taken by, other, not student necessarily, but other individuals within our department. And then, of course, a multiplier of time is being applied to, whatever time it took them to take the exam. Just before we move forward, you guys can hear me if I talk with this tone of voice, right? So the microphone there is actually working, which is a blessing. Great, thank you. So again, I think we have, just to assure fairness and give you a little bit of a background, it's like we have 4 faculties working on the exam. So hopefully that assures certainly fairness. And the exam will be pretty much the same for all AC 221 sections across the board. So we couldn't do it more fair than that, I mean, frankly. We tried to cover all the same material. So, I mean, obviously, depending on our personal and professional experience, we may have more facility with some material versus other, but at this stage of the game, frankly, it's basic information that we should all be able to explain it the same way. So typically, I mean, I don't talk about like I'll give you back the results. The results will be released after the exam, after everybody took the exam, because there will be people that take the exam, like they take a little bit longer to take the exam. And to that end, if I don't have anybody in this cohort that has requested additional time, as requested accommodations for the exam. So I am going to assume that you don't need it. But if you do, let me know as soon as possible, because we really have to set the system in a way that keeps into account that a particular individual will need accommodations. And then the last thing is that the exam is self-timed, and so it will shut down at the time, at the time you will, it's predetermined for the exam, which it should be around the hour. Like I said, I'm waiting for the coordinator of the course to sort of release the final information, but what we have discussed so far is that it should be around the hour. Any questions before we move on? So we have plenty of office hours. I mean, I think I'm the only faculty that offers 4 office hours, I realized, just because I try to split between students that are in outside the US, to whom office hours at night are more convenient than office hours during the day for time difference. But for purposes, of the exam, I mean, if you guys need to reach out, and our exam will be on Tuesday, but if you guys need to reach out to me, regardless if you are inside or outside the US, please make sure to come to office hours, whatever that is. I mean, if it's Tuesday night or Thursday afternoon. So I hope that, again, offering 2 different time slots at 2 different in 2 different days at 2 different times of the day helps not only to cover folks that are at different office hours, but also folks that have different kind of commitments. So, like some faculty will probably have additional office hours next week. I think we have it built it in as part of our system here. So, try to find the time to talk to me if you have any questions. All right, any questions about the exam? And again, we'll talk more between now and Friday, but I just wanted to sort of prep you and not to have surprise. We have the exam coming up. Any questions? No? Just as a reminder, we do not meet next Monday because we have the exam on Tuesday. So I'm going to send an email, but so people know. And Noah, that will be important for you too, because then you'll be attending an empty class. We are not going to meet next Monday because we have the exam on Tuesday. So excellent. Excellent. So having said that, let's get started, and we will continue talking about accounts receivable and revenue. As an FYI, obviously, our exam covers chapter 1, 2, 3, anything we have done on chapter 4, which is again like the cash and cash receivable, cash and cash equivalents, and then chapter 5. We're going to start possibly inventory on Friday, but that won't be part of our exam, so don't worry about that. All right, so like, as usual, I like to show little roadmaps here, and that's where we are. We are looking at revenue and accounts receivable. And from previous classes, from previous class, let's just refresh real quick what we have done so that we can continue with this class. We talked about where we found information in the financial statement. So we looked at the balance sheet of, in this specific case, Walmart, and we looked at cash and cash equivalents. And again, what are cash and cash equivalents? Like, cash equivalents is anything that can turn into cash within 3 months, that it is considered like equivalent to cash, such as securities that have a maturity date that is within 3 months. That's the most, I would say, important one. We also talked about in previous chapters how current assets are classified by liquidity, and you can actually see it over here. It starts from cash and cash, a cash equivalent, and it goes down. So the most liquid asset is, the most liquid asset is cash, and then it goes up to, the intangible assets, which are less liquid, meaning liquid means that turns into how fast it turns into cash. So remember that, sort of classification when we look at the financial statements, and also for purposes of your exam. So here you have a quick recap of what cash and cash equivalents are. This is what, like I said, we have looked at last class. So I'm not going to spend time into this, but I just wanted to offer a recap that pretty much everything that is cash related is assimilated to cash here is within 3 months of maturity. So keep that in mind, when you think about classifications. All right. Then we're going to be talking later on about receivable, and receivable I consider net of what? Of allowance for doubtful accounts. The allowance for doubtful account is the measure that tells me how much of my receivable will not be collected. So accounts receivable are money owed from customers from prior revenue transactions. So before we even think about receivable, the necessary condition for receivable to exist is that there is a revenue transaction. So before we even look at receivable, we look at revenue recognition. We talked about the revenue recognition principle, the 5 steps of the revenue recognition, of which the most relevant is the step of making sure that revenue are accepted by the customer. So that revenue being accepted gives me a sense of revenue being earned. And that's, again, from previous classes, that's like the earning of revenue is the most important element to actually recognize revenue. So then we talked about trade discounts, but I purposely didn't put them here, the trade discounts, just because, again, it's very easy, and it's supposed to be something that you guys should be able to, identify and solve quickly. But in terms of how the transaction looks like, when you have a trade discount, what happens is basically you book the net transaction of the revenue minus the discount. And you use a contra revenue account called the trade discount. So when it comes to return, though, things are a little bit more complex, quote unquote, because basically we have to think about different steps for the recording. Remember, we introduced an account that is called a sales refund payable, because typically companies book the expectation of a return. So in their financial statements, they know, I'm Best Buy, I am selling electronics. I know that based on historical data, typically my electronics will be returned with like X percentage of my electronics, say 20% that I sell during the month will be returned. And so companies do know that. And because one of the most important principles in accounting is that you have to be conservative. And whatever you can expect happening, you should book it in the financial statement so that your external users, or also your internal users, know what could be the impact on your earnings. So what happens is that as far as returns, we reduce the net sales by recording the sale allowance. And remember, anybody remembers what sale allowances are? The account is called save, return, and allowance. So sales return do not need to be further explained, but anybody remember what sale allowances are? No. So sale allowances, not to be confused by allowance for doubtful accounts, are reductions of price offered to a customer. So just sort of try to kind of make sure that you remember that as an information. So we reduce the net sales by recording a sale allowance or return, like the contra revenue account. Then we record the accrued liability for the expected sale reduction, for the expected sale value that will be returned. We increase the inventory into an account that is called the inventory estimated return, or that is basically, it tells me how much inventory is expected to be returned. And then we reduce the cost of goods sold by the same amount of the increase of inventory, because what we're trying to say is that if we expect a return, then that return will basically increase the inventory and reduce the cost of goods sold. Anybody can tell me, why would I reduce the cost of goods sold when I increase the inventory? Any sense why would I increase this is important. I mean, if we have doubts about this, I think we need to stop right here. Anybody has a sense? Fanju? Yachting? Anybody has a sense? So, okay. We need to, you had plenty of exercises on this, and you'll have plenty of exercises also when you review this chapter. So I really encourage you to go back and look at this concept. But the reason why I would reduce my inventory is because I would reduce my cost of goods sold is because I wouldn't have sold the merchandise. I mean, like, that's the idea of saying, like, if I increase the inventory, my expectation is that that inventory will come back. Therefore, the inventory that comes back is no longer sold. So it's expected to be no longer sold. And that's why I reduced the cost of goods sold. Can you guys hear me? Okay. All right. So, so those are the different steps. We talked about the transaction of red period that had 100,000 of sales for cash, cost of inventory sold 50,000, no prior allowance based on historical experience. So that was the sale transaction. And we looked at those transactions last class. I just put them over here because I want to sort of go back to the last transaction and pick up to continue. So no prior allowance. So Red Period had a sale of $100,000 with an inventory sold of 50,000. There was no prior allowance for returns. Based on historical experience, Red estimates that 20% of items that they are sold are eventually returned. So of that $100,000, 20,000 are estimated to be returned. Later in the current period, 10,000 of sales were returned to Red, and the remaining returns are expected in the following period. We looked at the transactions, which looked like this. The sale of inventory, $100,000. So we increased cash and we increased sales. Then we increased the cost of goods sold and we increased the inventory for that particular sale. And we decreased, the inventory for that particular sale. So again, my cash goes up, my sales revenue goes up, my cost of goods sold goes up, my inventory goes down. Do we understand that? Can somebody give me a sign or yes, no, maybe? Okay, thank you. Thank you, Mitra. Thank you, Yapping. So then the idea is estimates of the return. We said that here, Red Terrier estimates that 20% of sales are typically returned. So I am going to increase the contra revenue account of sales returns. And sorry, there you go. And then I am going to increase the sales refund, which is a liability, which is pretty much a reserve that shows me the expectation of my sales to be returned, and therefore shows the obligation that I have to pay back the customers. And then I will increase my inventory returns estimated by the amount of cost of inventory that it's supposedly going to be returned to me, and will decrease the cost of goods sold because I'll no longer have the sale. So this is this is to book the estimate of the return. I had the sale, I'm estimating the return, again, booking a contra revenue account, booking a liability, increasing the inventory for the inventory returns estimated, which is an adjunct account of the inventory account, and it goes pretty much condensed. It's condensed with the inventory account when it's presented in the financial statements. And then I'm going to reduce the cost of goods sold. When I have the return of the $10,000 worth of sale, I will reduce the refund payable because at that point, I no longer have the obligation for $20,000 to my customers, but that obligation reduces because I pay back 10,000 of it. I have returns, I estimate the returns for 20,000. I receive returns for 10. My obligation goes down by 10,000 because I no longer gonna have the obligation for the whole 20,000 because I received 10,000 of returns already. And I paid those returns for cash. Then my inventory at that point, my actual inventory will increase and my estimated inventory will decrease because I'm sort of reclassifying the inventory returned from an estimated to an actual one because I actually received the return. Does it make sense? Yes? No? Okay. So with this in mind, though, we made the premise, like people may say, okay, so what do I do with the remainder $10,000 of sales refund payable? That account typically gets replenished based on the needs of following period. And the next example, although it doesn't start with a $10,000 beginning balance, it gives you sort of an example of how the sales refund payable, if there is a beginning balance, is replenished as opposed to zero out because, oh, I didn't receive all these returns, so I don't need to put that obligation in my financials anymore. True, however, you're going to need that the next period. So let's think about, as opposed to zero it out and build it again, let's think about the replenish concept. So that's what we're going to be looking at in the next slides. All right. So let's assume that, again, like we are going to adjust for projected returns. This is example B. And we're going to be focusing on the sales refund payable. And basically, let's assume that Rhett Terrier has $300,000 of gross sales for cash. The gross inventory cost was $150 of the original price. So your cost of goods sold is 50% of the gross sale. So you have a gross margin of 50%. At the period end, Rhett estimates that $12,000 at sales price will be returned in the future. So Rhett has gross sales of $300,000, $150,000 of cost of goods sold, and there's an estimate of $12,000 of returns in the future. However, there's $3,000 in sales refund payable already. So what are the adjusting entries here? In essence, what we are saying over here is that you have a sales refund payable that is projected to be $12,000, but you already have $3,000 in the balance. So you really need to adjust just for now. If you add the $9,000 to the $3,000 you have, you're going to reach the targeted amount of return, which is $12,000. So again, I have $3,000 already in the account from previous periods. My goal is to have estimate returns of $12,000. If I have already $3,000, I need to adjust only for $9,000. Does it make sense? Okay. So with that in mind, this is pretty much my adjusting entry. Oops, sorry. So I need an adjustment only of 9,000. So my sales return and allowances will be increased by 9,000. Remember, why is it debited? Sales returns and allowances? It's a sales account, why it's debited? It's because it's a contra revenue account. So it reduces the revenue. And so in that specific circumstance, I am increasing the sales return and allowances, and I am increasing the sales refund because I'm adding to the 3,000 obligation that I have, 9,000 obligation to get to a total of 12,000 obligation that I have to show. Then I increase the inventory returns estimated, and I decrease the cost of goods sold. Anybody can tell me why it's 4,500? Shane? Soho? That is correct. So it's 50% of sales. Thank you. So it's 50% of sales because your cost of goods sold is considered to be 50% of sales over here. All right. So so again, my sales goes this is the journal entry, which it shouldn't be new to you, but it's the tricky part here is that you have already a $3,000 balance in the sale refund payable account, and if you need the 12,000, you're just gonna adjust by the delta. You don't need to book the whole thing. So what if at the time of the return, what's gonna happen? At the time of the return, let's assume that you actually get $12,000 of returns, then your liability will go down, your cash will go down. Your inventory, your actual inventory will increase because you're going to reclassify inventory returns and estimated so you're going to reclassify that amount from inventory returns estimated to actual inventory. So that amount is no longer estimated, it's actual inventory. And by how much you're going to do it? By the 50% of 12,000, which is the value of your cost of goods sold. What if, so do you see here an impact on the earnings? Is there an impact on the earnings? Meaning, is there an impact on the income statement if you look at this? Do you see an income statement account in these transactions? Soumya, do you see an income statement account in these transactions?
Well, for the sales refunds payable, we would have to take from the assets that we have and the cash that we have to pay back, right? So
I'm sorry, we can't hear you.
Oh, I'm sorry. I'll type it.
Well, but that's an issue though.
You just dropped the volume.
Yeah.
Hello,
Here.
can you hear me?
We can't, but we'll bring the volume up. See if it works now. Go ahead, Soumya.
I was just thinking that with sales refunds payable, you now have to like give back some of the money that you would have earned prior. So you're like, the income you have is going to be deducted because you have to pay back.
Right, but is sales refund payable an income statement account? Anybody? This is not for Soumya only. Martine, you're saying no. Why?
All of these accounts are for the balance sheet.
Yes.
The income statement, so it won't affect like the income.
So Martine is saying those accounts are balance sheet accounts. So this journal entry won't affect the income statement, which is correct. Quick question. Does it make sense the L and the A at the end of each account? Like, do you know what that L is next to the state refunds payable?
Does it mean liability or
that is liabilities? Whereas the A means assets, and liabilities and assets are accounts of the balance sheet. So there's no income statement account over here. All right, so the idea is that when the sales refund payable will occur, there won't be impact when the actual refund and return will occur, there won't be any impact on the earnings. So that's the idea there. So again, at the time of return, your sales refund payable liability will be decreased because we no longer have the obligation. Cash will decrease because we're going to be paying cash the client. Inventory will be reclassified from inventory returns estimated to actual inventory. Okay? In a situation though, you have estimated $12,000 worth of returns, but in reality, you get 15,000. At that point, you will impact the income statement. At that point, you'll impact the earnings because your estimate wasn't as such that you have sort of estimated the actual returns. So meaning your estimate was a conservative or there's probably nothing wrong with your estimate. It just so happened that you had more returns, which is normal. it's okay. But the idea is that you try to impact the income statement in the period. So said differently, if we look at this transaction over here, here you go, you have here the sales return and allowances and the cost of goods sold. You impact the income statement so that at the time you make the estimate, so you don't have to do it when the actual entry, the actual transaction happens. Because the idea is that you should be able to estimate returns at the time you make the sale, at the same time you make the sale. Because for the matching principle, the cost of the return, the expenses associated with the return should be booked in the same time you book the revenue, because the expense and revenue recognition principle will tell you that revenue are booked when they're earned, and expenses, including the ones associated with the return, are booked within the same period the revenue occurred. This is a cost of making sales. The fact that you have to think about expected returns. So you have to book them at the same time of the sale. Therefore, when the actual return happens, it's not going to impact your earnings anymore. All right. So having said that, we're gonna here, I'm giving you an example of a footnote that says of Walmart that says the company recognizes sales revenue net of sales taxes and estimated sales returns. So that's what it means. And it tells, like what we just saw is what that means over there. And then the last paragraph tells you estimated sales returns are calculated based on expected returns. When you see that in a footnote of the financial statements, it means exactly what we have just seen and what we just studied. So now we're going to switch gears, and any questions before we move on? Okay. Now we're going to switch gears, and we're going to talk about uncollectible accounts. So we said, I cannot have an uncollectible account unless I have a sale. So we looked at sales, we looked at trade discounts, we looked at returns, we looked at, most of all, revenue recognition. Now we made the sale. Let's just think about, are we going to collect that sale, yes or no? So I'm going to show you again our sort of roadmap. We looked at sales revenue, and now we're going to be focusing on accounts receivable. So what are accounts receivable? Are dollars owed by customers from previous revenue transactions. When we recognize the revenue, when we recognize the accounts receivable and revenue, obviously the sale has to be on account for you to have accounts receivable. If it's for cash, this is a new point and it's not even applicable. But so if you make a sale on account, your accounts receivable will increase and your revenue will increase. When the customer pays, your cash will increase, and your accounts receivable, which tells me how much customer owe me, will decrease. Any questions with these transactions? These are the basic, there's nothing, we can do unless we are pretty clear on these transactions. Do they make sense? Okay. So what happens if a customer doesn't pay? Here, we are saying the customer pays. Well, what if it doesn't? Or what if partially pays? Then we have bad debts, uncollectible accounts. So there are two methods to account for uncollectible accounts receivable. There's the direct write-off method and the allowance method. You're going to learn in a moment that the direct write-off method is not allowed under GAAP, and the allowance method is, just because the first one doesn't really follow the matching principle. So why the first one doesn't follow the matching principle? Well, the direct write-off method, it's also called specific write-off method, tells me no matter when, I'm going to book my accounts receivable, and I'm going to book the uncollectible accounts when I hear about that account is actually uncollectible. Say, for example, I have made a sale today, and so I booked the revenue, which impact my earnings, and I book the accounts receivable. And comes January 2021, I hear that the client, I made a sale of $150,000. The client is going to be able to pay me only $50,000. So how much is uncollectible of that sale? Samantha, how much is uncollectible of that sale? I'm going to repeat the question. I made a sale of $100,000 and the client today, and the client tells me in January that is going to be able to pay me only $50,000 of that sale. How much is uncollectible of that sale? How much I'm not going to collect? Funny, why 500?
You just say 50% or 5%.
No, okay, I don't. So I'm not sure. I'm not sure I understand the answer. I'm sorry. The question was, I made a sale of 150,000. The client tells me in January that is going to be able to pay me only 50,000. How much I am not going to collect? Anybody?
100,000.
100,000. Yes, 100,000. So I'm not going to be able to collect 100,000. So that means that I'm going to book the revenue of 150 in year 2020, and in the earnings, I'm going to show that I have a bad debt expense associated with that revenue for $100,000 in year 2021. Where's my matching principle? I'm going to have my earnings of 2020 overstated by 100,000 because I booked a sale of 150 and instead of 50,000. And instead, the financial statements of 2021 will be understated by 100,000 because I waited until 2021 to show that this could have been uncollectible. Some of you may say, well, I don't have the crystal ball. True. You may not be able to realize like how much you're not going to be able to collect at the dollar, but there should be, and that's what the allowance method does, because like I said, this doesn't follow the matching principle. There should be an expectation that based on previous experience, similarly to what we have done for the sales refund payable, based on previous experience, you should be able to make an educated guess of how much typically you do not collect. And when do you do that estimate? Within the same period of time of your revenue, of your sales. So within the sales, again, you are supposed, for the matching concept, to match all the revenue with the expenses associated with that revenue. Guess what? Bad debt expense is an expense associated with that revenue because you have the sales, you have the cost of goods sold, then you have to think about, all costs associated with generating that sale, paying the employees, paying the rent and all that, including the expense, so the cost associated with the losses of not collecting your revenue. So again, the allowance method recognizes the total expenses losses related to a particular year within the same period of time of the sale. And then it's periodically adjusted. So it's a sort of an amount that is adjusted over time and it's replenished as needed, similarly to the sales refund payable. And obviously, because we sort of match the revenue with all the losses or expenses associated with that revenue, including bad debt expense in the same period of time, that satisfies the matching principle. So having said that, there are, again, like how it's going to look, how my accounts receivable will look like. First of all, the accounts receivable are valuated at the net realizable value. So you have the gross accounts receivable less the allowance for uncollectible accounts, which is the account that we use under the allowance method. It will give me the accounts receivable net. Now, how did you come up with the estimate of the uncollectible accounts? I mean, you don't come up with that out of thin air. How do you do that? There are, there are two methods, but the idea is percentage of sales and percentage of accounts receivable. But the idea is that regardless of the method, these will be the transactions that you'll be looking at. So suppose you made a credit sale of $20,000. You estimate that 2,000, and again, we're going to look at how we make that estimate in a moment. You estimate that 2,000 will become uncollectible without knowing specifically which customer will end up not paying. You know that out of a pool of $20,000 worth for sale, 10% of those sales, which is 2,000, typically are not collectible. How do you report that? You first record the revenue. So you increase the accounts receivable and increase revenue by 20,000. And then you book an uncollectible account expense and an allowance for uncollectible accounts. Does everybody what is the XA here? What does that stand for? What do you think that is? We have seen XRs. So if this is an asset, this is a retained earning slash stockholders equity account. Well, not account, impacts the retained earning, the stockholders equity. This is an uncollectible expense. What is this which impacts retained earnings and stockholders equity? What XA means? It's a contra asset account. So is that account increasing or decreasing right now? Being a contra asset. Zealand, is the account increasing or decreasing? The account is increasing. Yes, thank you, Sean. The account is increasing because contra asset accounts work with a logic opposite to the asset. So they increase by credit and decrease by debit. So again, right there, I'm booking the estimated, losses. So the uncollectible account expenses and the allowance for uncollectible accounts in the balance sheet. So my net realizable value of the receivable will be $18,000, will be the 20,000 minus the allowance for uncollectible accounts. Right there. That's how I'm going to look in the balance sheet. So having said that, again, like we talked about the allowance for uncollectible account being a contra asset. Having said that, that's why my receivable are net. Net of what? Of the allowance for doubtful accounts or uncollectible accounts, whichever you want to call it. All right, so if you look at the footnotes of Walmart, you're going to see that it says that receivable are stated at their carrying values, net of reserve for doubtful accounts, because I mean the allowance is nothing more than a reserve, and it tells you the value, like in the last paragraph, as of January 31st, 2020 and January 31st, 2019. It tells you the amounts of the receivable respectively, net of the reserve for doubtful accounts. In some presentation of the balance sheet, you're also going to find, or in the footnotes, you may also find the value of the actual allowance. So how do we understand, how do we come up with that $2,000? How do we come up with the uncollectible accounts and we make estimates of the allowance? There are two methods. There's the percentage of sales, where pretty much we estimate the amounts of uncollectible accounts based on the percentage of sales of a given year. And then, and basically, we make an entry increasing, so debiting the bad debt expense and crediting the allowance for doubtful account. That's what ADA stands for. The second method will be the aging or percentage of receivable. So one method estimates the allowance based on percentage of sales. So based on the percentage of sales of a given year. The other method estimates the allowance needed, like the uncollectible accounts of one particular year, based on the percentage of receivable. We adjust for the aging of accounts or accounts receivable or percentage of receivable method. We adjust the balance of the allowance for doubtful account so that basically, oh, somebody has a question. It looks like, hold on. Oh no, that's old. So basically, we adjust the balance so that if we, the balance will be the ending balance of the allowance for doubtful account is what equals to the percentage of receivable. Meaning, if I found that the percentage of receivable is supposed, say I have made I have accounts receivable of $250,000, and I say that 10% of their receivable is not collectible, then my expectation is that the balance of the allowance for doubtful account is going to be $25,000. The bad debt expense, it's whatever balance I have to adjust the account for to get to the $25,000. I mean, this seems, it is, I gotta say, this is probably, so far, is probably the most complex transaction we're gonna talk about, and we're gonna talk about it in the next class. But I just want you to, focus on it because it's really important, not only for your knowledge, but obviously from a utilitarian standpoint of your exam. So, we're gonna talk extensively of what aging of accounts are. Percentage of sales, on the other hand, is very easy. However, bad news is the aging of accounts or percentage of receivable is widely used among companies. So you really need to sort of gather an understanding of that. So percentage of sales looks at past trends of collections based on sales. So the uncollectible accounts expense is based on the percentage of sales of a period, regardless of the balance in the allowance account. So what does that mean? Let's make an example. Sears starts, and this is going to be the last topic we're going to talk about. Sears starts his business. It sells microwave ovens for $10,000. Customer paid for 4,000 of these sales with cash, and the rest of their Sears credits of their Sears credit cards. When Sears makes his credit sales, it estimates from past experience that 5% of credit sales will never be recovered in cash. So first and foremost, you have cash that goes up by 4,000, and the remainder is on accounts receivable. And the obviously increased sales revenue by 10,000. So you have accounts receivable that is for the portion that has been paid with Sears credit cards that then the client will go and pay the credit card balance to Sears for. So that's the idea. How much will be the value of the uncollectible amount? Again, from past experience, 5% of credit sales will never be recovered in cash. So how much will be the balance? $300. Yes. Because it's 5% of the balance that is not being collected yet. So first challenge here, we are not talking, 4,000 was already received. So the 5% has to be on the credit sales. The credit sales were 6,000, so 5% of that 6,000 is 300. So we'll book the uncollectible account expenses 300, and the allowance for uncollectible account will go up by 300. Easy. So what is the net realizable value of the accounts receivable at this point? It's 6,000 minus the 300, 5,700. Again, nothing, what is this so far? So we're gonna stop here, because that's pretty much like what I wanted to go through today. And we're gonna continue with what happens when the client then doesn't pay at all, like you have certainty that the client doesn't pay. And then also we're gonna continue with percentage of sales next class. I'm sorry, percentage of accounts receivable next class. I just want to pause for a moment and say that I do realize like this is a very, difficult semester for everybody. However, it would, like I would encourage you to keep up with, reading the material, review the slides, as trying to play catch up on October 5th, the day before the exam, it will become a pretty exhausting exercise. So not to mention that, it becomes very frustrating, I would think, participating into a class meeting and having sort of difficulties like following what we are explaining here, because I mean, it would be difficult also to take meaningful notes, frankly. So, all right, with that in mind, I thank you so much for joining me today, and we'll see you on Wednesday. Thank you, guys. Bye.
Thank you.
Thank you.